and I'll be talking about the value added tax. In particular, I'll be taking you through the VAT apportionment. As you all know, we have two basic methods of VAT apportionment, that is the standard alternative method, which is sum, and also we have the standard method of apportionment, which is the SMA. So, starting with the VAT input, under section 28 of the VAT Act, VAT is incurred by a taxable person in respect of taxable supplies or purchases. And we also have what we call uncreditable VAT input, that is under section 28 subparagraph 5 of the VAT Act, where no credit is allowed for some taxable or import of passenger automobiles, repair and maintenance, with exemptions to people in that industry of maybe automobiles, when you're dealing particularly in automobiles. We also have entertainment, unless the taxable person is in the business of providing entertainment. For example, radio business, like for the balams and marketing agencies. We also have telephone services to an extent of 10%. When it comes to bills of airtime from MTN, they only allow 90%. 10% is not allowed. So that's what we mean by the uncreditable VAT input. I'll try to be brief and quick through this video to make it short. As I said, we have two types of supplies. We have the taxable supplies, that is section 18 of the VAT Act of Uganda. Under taxable supplies, we have the taxable, we have the standard rated, which is the 18%, and the zero rated. And then under exempt, which is the other type of supply, section 19 of the VAT Act, we have what we call the exempt supplies, which can be which are specified in the second schedule of the VAT Act. In case you want some of the examples, such as the supply of financial services, processed milk, among others, you can check out the second schedule of the VAT Act. For zero rated supplies, that is in the third schedule of the VAT Act, you can check it out for more examples on what belongs to the zero rated services. But I'll give one example of where goods or services are exported from Uganda as part of supply. This is basically a quick theory about VAT before we look at or we dive into our two methods. Moving further, we said for supplier to qualify for apportionment or to apportion his input, he must be dealing in both taxable and exempt supplies. So, instances whereby a supplier is only dealing in taxable supplies, he will not be required to apportion his input. It will be all allowed. But in instances whereby you have both taxable and exempt, that's when apportionment comes in. Standard method of apportionment, which is also known as the default or the normal method, is the default or is the mostly commonly used method of apportionment by most of us, where all the input tax incurred by a taxable person is subject to apportionment in a particular period or month. So that's the most common method most of us are using currently, for which whereby in case we're dealing both in taxable and exempt supplies, all our input will be subject to apportionment. There are a few, one or two rules that govern the fraction of B over C under section 28 and 9 of the VAT Act on when or what should we look out for before we say we need to apportion our VAT. I'll just maybe shift a bit in my presentation and come to this part of the formula of the SMA or normal method, which is A times B over C, and B over C is the fraction we're talking about, which is our litmus test we use to see are we below 0.05 or are we above 0.95, or are we between 0.05 to 0.95? Anyway, we'll start by elaborating more about the formula. A stands for the amount of input credit for the period, that is the input credit you have, the total for the period. B stands for the total taxable supplies. By taxable supplies, I mean standard rated sales at 18% and zero rated sales at 0%, for example, for the exports. And then C is the total amount of supplies, that is both taxable and exempt. I just dived into here to have a small glimpse on the method, a breakdown on what it means. So I'll go back to where I was trying to explain the rules that govern the fraction under section 28 and 9 of the VAT Act. There are three rules basically. One, it says where the fraction of B over C, we have seen what B means and C means, is less than 0.05, the taxable person may not credit any input tax for that period. What did I mean by this? In case you get your taxable sales total over the total sales, and the answer you're getting or the value you're getting is less than 0.05, no credit for input tax will be allowed completely. Then the instances whereby the fraction of B over C is more than 0.95. If it's more than 0.95, the taxable person may credit all the input. And then where the fraction of B over C, where B over C is between 0.05 to 0.95, the taxable person is required to apportion the input. So these are the rules you should look out for and consider when it comes to the standard method of apportionment, or the normal method, or the default method of apportionment of VAT by the taxable person. So as you have seen, you have said where the fraction is between 0.05 to 0.95 will apportion, and in most cases our fraction will be between here, which will push us to our next interesting topic, or a chapter of apportionment is done to determine the percentage attributable to the taxable supplies and that for the exempt supplies. Where are we apportioning? Basically, we want to claim only that percentage that is attributed to the taxable supplies. That's what the taxman is interested in. Moving forward, I'll just give a simple, quick overview on the other method of apportionment, which is the standard alternative method, most commonly known as the sum. The sum can be found under section 28 and regulation 14 of the VAT Act. This method is not so common, and in most instances for people who claim or say they are at a disadvantage by the SMA, the standard method of apportionment, will write to the Commissioner General to request or to approve them to use the sum methods. I'll not go into detail in this method for today's video because our interest is basically on the other method of standard method or the normal method. So diving into an example, a practical example on this. Here we have a practical example, and I think whatever I've just summarized in the theory, we'll try to dig deep in brief or in real life scenarios to see how we can understand more when we're filing our returns. Given the fact that now we have web-based tax returns, life has been made simple when it comes to filing our returns for the tax consultants, the accountants. You don't need to spend a lot of time doing now the returns, particularly for VAT, the rental, yes. But when it comes to payee and others, we're still doing we're submitting in our forms, whereby you have to download the template, validate, then submit. But anyway, back to the example. The practical example for today, it is Dembe Uganda Limited, a VAT registered company based in Uganda. You have to keep note that the company is based in Uganda. Our sales for the month are given here. We have 1. These are the sales we are going to consider, and these are the purchases we are going to consider. Let's say this is for the month of November 2023, and these are the purchases for the month of November 23. So, without wasting time, let's go through the practical examples. These are scenarios which may occur at your workplace. For example, one says that, let me highlight it. One says, let me make it a bit lighter. Issued an invoice for shillings 42 million to Fangon Unit platform for the purpose of locally developed computer software, its maintenance and software license. Yes, here they're saying we issued an invoice to Fangon Unity platform. Don't mind about the example. We're just using the name. It's not for any political use or anything. Yes, and that's the example. It's talking about an invoice we issued or a sale we made to Fangon Unity platform for the supply of locally developed software. What does that mean? When it comes to locally developed software, you must be very conversant with your tax act, the VAT Act. And most times I recommend accountants and consultants to have a copy of the act, the updated version each year, to avoid any errors that may occur in the classification of some of these items or in categorizing some of these expenses and sales. So, when it comes to supply of a software, the supply of a software and maintenance of a locally developed software, this is a locally developed software. I'll put that in red. That is exempt supply as per the second schedule of the VAT Act. I've also specified it here for you. When it comes to a locally developed software, it's an exempt supply as per the second schedule of the VAT Act. What does it mean? We'll have a summary down here of the output tax schedule for November 2023, particulars, category, amount, tax rate, and the VAT payable. So, starting with the locally developed software, we have said supply of locally developed software or computer software, it is an exempt supply as per the second schedule of the VAT Act, implying the tax rate will be nil and the VAT payable will be nil. Okay, so that is done. Moving on to the next, we have the company provided consultancy services for 20 million Ugandan shillings to an Indian company in Kenya. Remember, we say this company is based in Uganda, and we provided consultant services to an Indian company in Kenya. What comes to our mind? That is a zero-rated sale. So you must also be conversant with the third schedule of the VAT Act, which incorporates the zero-rated sales. So consultant services to a Kenyan company is a zero-rated sale, and it will be taxed at a rate of 0%, and the VAT payable is 0. Okay. Moving on to the last sale we made in the month. This is supply of legal services to Fangon Unit platform for shillings 80 million at their offices in Kampala. As we know, legal services qualify for VAT, and this is a standard rated supply. So we'll come to our particulars, add legal services. We said it's a standard rated supply, and the rate applicable is 18%. 18% of the 80 million, we get 14 million. So then down here we come and get our total output for the month of November, which will be 14 million, because this was nil and this was at 0%. And then our total sales for the month of November are 115 million, for which taxable sales are 100 million, for which taxable sales are 100. Let me even put it in bold and make it. Our taxable sales are 100 million. That is 80, which is the standard rated sale, and the zero rated sale of 20, making it 100. And then the exempt are 15 million. Now, maybe you note that we said the B over C fraction, where B over C, we have, let me even take you back there to the rules when it comes to applying this method of standard method of apportionment. where the fraction of B over C is less than 0.05, the taxable person may not credit any input. So we are going to test that. And where the fraction of B over C is more than 0.95, the taxable person may credit all the input. We also look out for that. And then where the fraction B over C is between 0.05 to 0.95, between is a key word, the taxable person is required to apportion. So if it's between that, we are required to apportion. So those are the three basic rules we have to look out for. Now, we proceed. We are done with the sales output for the month. We proceed to our purchases down here. We have received an invoice for office telephone bills, 15 million. Remember we talked of the uncreditable input, and we mentioned some of the things like telephone services to the extent of 10%. So you need to be well conversant with the tax laws, or you have to involve a tax consultant in most cases whereby you're not sure. Most of us, we don't consider some of these things. For example, when you get an invoice from MTN for the airtime, or for the voice bundles, or for the corporate services, we are allowing all that input VAT. But that's not the case. We are supposed to allow or to claim only 90%. As you can see, my phone office telephone bill down here, I'll highlight it with yellow. It's a standard supply, yes, but only 90% is creditable. So 15 million, the total VAT input is 2.7. This times this, we get 18, 2.7. We have creditable and uncreditable. So we are saying out of this, we are only crediting 90%, and the 10% is uncreditable. So we'll only consider the 10%, the 90%. The 10% is not creditable. As we say, we talked of the telephone services or bills, only 90% is allowed because we say 10% is not creditable. We talked of the repair and maintenance and import of automobiles. Unless you're in that business, you're dealing in that business, particularly as your main activities. We proceed to the next. We have received an invoice for water bill, 5 million. Water bill qualifies for standard rated, and we'll come here and put the standard rated water bill. Standard rated supply, 5 million. 18% of that, and it's all creditable. We allow all of it. We go to the next. Received an invoice for rent, 8.5, for which 5.4 was for office, and the balance is in respect of the director's residence. Office rent is standard rated, and we will recognize it here, 5.4. 18% of 5.4, which is 972, which is creditable as allowable. Then director's rent, that is an exempt supply as per section 1 of the second schedule, section 1F of the second schedule. If you read it, you'll understand it. But it's more or less saying that your landlord is charging you VAT for your accommodation where you stay. So that is exempt under section under the second schedule of the VAT Act, subparagraph 1, paragraph 1, subparagraph F. And for this, we will have it as nil. So we cannot claim any input on it. Despite you may find some of the landlords charging people rent for accommodation, like private purposes, and but it's not allowed. I expect it's happening by some of the real estate developers. They are billing individuals or companies, they're billing them the same way. When you move on to the next, we have IT services. These are standard rated, but I'll go back maybe to the question and say the company paid work consults for IT services of 10 million. Yeah, that's an consultancy service and standard rated, and will charge VAT at 18%, which is creditable also. Then we go to the fifth line, which is talking about bought fresh flowers from Kajansi Florist Limited, shillings 55 million for burial services. Now, when you buy fresh flowers from Kajansi, my SP spelling, for burial services, fresh flowers from Kajansi for burial services are exempt supply under the second schedule of the VAT Act. So burial services and cremation services, they're exempt services. So we will not pay VAT on them, and as you can see, it is nil. So after that, we get our total of our creditable input as 6.1, and then 270 as uncreditable input. Now, once we are done with all that, sorry, we have one more here, item 6. Item 6 says the company Dembe, this company, the Ugandan-based company, paid 5 million to Adobe Incorporation, a firm based in the US, for designing a security system for its servers in Kololo. Now, I guess most of us have heard about the word imported services. It's one of the key items which is being considered during the URA audits, and many people are being caught off guard when it comes to imported services. One is wondering, how does it work? Who pays the imported service? For today's video, I will not go into details, but the imported service is paid by you, the client, who is paying for the service to Adobe Incorporation. So you don't supposed to pay for the incorporated services, and you go ahead and raise the IFRIS Revenue Authority. So when it comes to the 5 million paid to Adobe for the security service, yes, it may be online. They didn't need to come to Uganda to offer us the service. It was online, but they accessed our servers, of which our servers are based in Kololo, Kampala. So that becomes an imported service. Yes, very interesting topic, and it's one of the things whereby during the current URA audits, they are using it, and URA is collecting some good money from various entities when it comes to those licenses and what for various consultancy services, for services offered online. So our imported service, yes, as we said, it will appear, it is not an output tax, but it will be added to our tax payable in the end. And for 5 million here, we have 18% rate, it's 900,000. So once we're done with all that, we said you're applying our method of SMA, or the normal method, or the default method, which is A, where we said A is the total input. Maybe I'll work it out here with you again. Let me just delete this. We work it out again. We fill in this together. So we said A is the amount of input credit for the period. I'll use the formula here. Amount of input credit for the period. And our input credit for the period, it is this 6 million here. We talked of B, the total amount of taxable supplies. And we say taxable supplies is a combination of both standard rated and zero rated. And if you move forward here, we don't take the VAT amount, we take the amount, the sales amount before any tax. That is the zero rated plus standard rated, and that is 100 million. And then C is the total amount of all supplies, that is taxable and exempt, which is 115. Then our B over C function would be B over C will be at 0.87, and we said one of the rules was saying that, let me put it in red, where the fraction of B over C is between 0.05 to 0.95, the taxable person is required to apportion input VAT. And now you can see clearly that our B over C fraction is 0.87, which is between 0.05 to 0.95. So we need to apportion our input credit. So coming down here, I'll apply the formula, which is this times B over C, which is already here, and I get my total input credit allowed for the period as 5 million. So out of 6 million, we are only allowing the formula or the SMA method or normal method will only allow 5 million as the input credit that relates to the taxable supplies. So in the end, we'll go ahead and make our tax adjustments for the end month. For the tax payable, where we bring our output tax. Our output tax, we had it as 14 million. And then we bring, after that, output minus input tax allowed, which is this. We get our tax payable from the taxable supplies, which is 9 million. And then we add our imported services, the tax, the 900,000, which we had here. That's why it comes. And we get our total tax payable for the period. So that is it basically when it comes to the SMA or normal method of apportionment. In case of any questions, please comment in the section below. I'll try to respond to them as much as I can. Down here, I was trying to bring up something on the penal tax for failure to file your return. Most of us, you see that figure, or you wonder, how does URA come up with some of these figures of the penalties in case I don't pay my taxes immediately? But I'll do a video on that next time. For today, I think we'll end here. I hope the video was helpful. For those that requested for the video, hope I try to be a bit elaborative and, it helps you. Thank you.